How to trade 101. This is the part you've been waiting for. How do we trade? Now it's pretty straightforward. Like I said, you're either buying currency or you are selling currency. But now there's a formula to do this. Why is the formula to do this? Because every time you take a trade, you are not 100% sure if the market will go in your direction or against your direction. That simply means that you can say, okay, I want to buy, and then you buy, and then the market starts selling after you buy. What that means is that you are losing money. So to trade, there's a formula to trade, and that simply means that you set up your trade in a way that you tell yourself, okay, I'm going to buy gold, for example, at 1,000. The price of gold is 1,000, right? $1,000. This is for example. Now, the price of gold is going to go from $1,000 to $1,100, right? When it gets $1,100, I'm going to withdraw from the market, meaning that I have made $100. So you set your target, meaning that I'm buying gold at $1,000 and I'm hoping that the price of gold will get to $1,100. But when you enter the market, because you know that just at times, the market might not move in your direction, the market might go against you, what you've analyzed. You now put what is known as a stop loss, like I said earlier in definition of terms, a stop loss. You now tell yourself that, okay, in case the market doesn't go in my direction, doesn't go from 1,000 to 1,100, and it decides to reverse and starts going back, right? When the market goes from 1,000 to $950, I will close that trade, meaning that I have lost $50. And that's what is known as risk to reward ratio in trading. Every trader does that. So when you enter a position, you give yourself room. It's called your stop loss. How much am I going to lose in case this market goes against me? And how much am I going to make if the market goes in my direction? Now, what the idea is that where you set your stop loss, that is where the market will go against you, must be smaller than your take profit. That is, on every trade, you must make more money than you lose money, just in case. So if the trade goes against you, you lose money, but the money you are going to lose will not be as much as the money you are going to make if the trade goes in your direction. Hope you understand. That is known as risk to reward ratio. Pretty straightforward. Remember this. Price, for example, again, I've used gold. For example, gold is $1,000 and you buy at $1,000. You tell yourself, if the price goes up to $1,100, I have made a profit of $100 and I will close that trade. I've profited. But if the price goes against me, if the price decides to drop and not go in my direction, if it goes against me, that means I would lose money, but I'll not lose more than $50. That means if the price drops to $950, I will close the trade, and then it means I have lost $50. That's how to trade. That's basically how to trade. You lose less and you win more. That is how you become a successful trader.